Well, there is going to be a break point, because if the economy becomes uncertain and consumers sit on their hands or confidence falls and businesses slow expansion, the economy risks going to stall speed. And nobody wants the economy to go to stall speed, because if you enter a recession, it'll force the administration to unwind everything. I do think there is a strategic value in the U.S. owning a commodity that actually could rise in value, because it does change the way markets eventually see the U.S. deficit. Because if Bitcoin is something that is rising and the U.S. owns 1 million of Bitcoin and they're going to hold it for 20 years, that in some ways could actually offset a lot of the deficit.
What if I told you that the next global financial disaster could be triggered by something as unpredictable as Bitcoin's price swings? Yes, you read that correctly. Tom Lee has just unveiled a wild, thought-provoking theory that might leave you questioning everything you thought you knew about the global economy. The world is already teetering on the edge, with uncertainty building in every corner. Confidence is waning, businesses are hesitating to grow, and the economy is dangerously close to hitting stall speed, a point where it could slow so much that it risks crashing into recession. But Lee introduces a shocking proposition. What if the US could hold a massive stockpile of Bitcoin, millions of them, over the next 20 years? He argues that this could have a profound impact on the global financial system. At first glance, it sounds ridiculous. How could Bitcoin, with its insane volatility, be a stabilizing force? But Lee suggests that its unpredictable price fluctuations could actually be used to hedge against inflation and reshape the way the market perceives US fiscal health. What's even crazier is that the same asset that could save the US economy might also set off a market crash, sending shockwaves throughout global markets. Bitcoin, with all its chaos, could become the most dangerous and powerful player in finance. Let's watch clips from Tom Lee's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Markets were very enthusiastic after the election because they saw a pro-business administration, a cabinet that had a lot of what they looked at as market-friendly folks, and what they viewed as a Trump put, which would be there would be downside protection to stock markets. And I think that carried over for most of the start of this year. It's become evident that consumers and businesses have become a little more uncertain because of tariffs and the effect it's going to have on the economy. So the economy is slowing. And then measures like Doge, which have really cut a lot of federal spending, and some of these programs like US aid are potentially leading to a softening of the economy itself. And so now investors are wondering, are these Trump initiatives actually good for markets? And that's why we've had many stocks come under pressure. Both consumer confidence surveys, University of Michigan and Conference Board, the respondents have listed tariffs and the uncertainty around that and Doge as a bigger concern than inflation. In the regional Fed surveys, many businesses have talked about how they're uncertain if tariffs happen, if they can pass on those price increases, and it is causing them a lot of uncertainty. And then if you look at earnings transcripts for both S&P 500 or the broader Russell 3000, comments about tariffs are at 7-year highs. So there is clearly a lot of uncertainty, and uncertainty, of course, causes people to slow down their activity. Well, there is going to be a break point, because if the economy becomes uncertain and consumers sit on their hands or confidence falls and businesses slow expansion, the economy risks going to stall speed. And nobody wants the economy to go to stall speed, because if you enter a recession, it'll force the administration to unwind everything. Because as you know, when you have a recession, you have to have fiscal expansion, meaning no austerity, spend a lot of money, and it reverses all the things that the administration's trying to accomplish. And similarly, the Fed wants to avoid stall speed, because instead of worrying about full employment and inflation, if employment starts to weaken, the Fed has to go into easy money right away. Which means a put, of course, exists at a certain level. There are going to be distributional consequences of any policy. So I think it makes sense that if Doge wants to reduce federal waste, by necessity, it does mean lower federal employment. The question that we don't know the answer to yet is this necessarily damaging the economy? We know that in general, private sector spending gets crowded out by government spending. In other words, in an economy, government spending essentially competes with private sector. So if you're shrinking the government sector, it is reallocating money to presumably a better return on invested capital. So it should actually be better for GDP. But as you're pointing out, in regions that are affected by Doge cuts, there will be unemployment. It's not that different from globalization in the 80s and 90s, which actually left many states in the US without manufacturing jobs. And I think that Doge is sort of similar. So I don't think in that experience of the 80s and 90s, US growth actually slowed, it actually improved. I think ultimately Doge will hurt some regions, and it's going to probably be good for the economy. And it's apparent when you look at the Fed minutes, the discussions at these meetings, that many FOMC members are just uncertain of the consequences of tariffs and the new policies. On the surface, they realize it creates short-term inflation pressures, but the long-term consequences are unknown and possibly would slow the economy. So I think that the Fed's decision is really to be on hold until they have visibility. The market views the Fed on hold as a hawkish pause at the moment, meaning the Fed realizes the employment market isn't creating inflationary pressures, but the current inflation environment isn't necessarily convincing them that inflation is set to cool again, especially with tariffs. I think that this whole conversation will change if the labor market begins to soften. So coming back to Doge, it's possible that it's either the February or the March employment reports begin to show the negative effects of these layoffs and these terminations. And if that's the case, this will pull the Fed off the sidelines. And so the Fed has to go into full dovish mode. Oh, I think without question, if the labor market softens, the Fed is going to be cutting rates. And part of that is the Fed has acknowledged that last year, a lot of the inflation we're seeing is what they would call statistically lagged inflation. Things like shelter, market-based measures of shelter are showing much less inflation than the official measures, or auto insurance, which is just lagging market movement. So I would say the Fed itself acknowledges inflation, even though they may not win the PR war there, meaning markets aren't convinced inflation's cooler. Market-based measures show inflation's much softer. So I think they would end up cutting. The ISM manufacturing report for February, which came out today, the employment index component was 47. So you're already below 50. A lot of the regional surveys are already showing CapEx plans are pausing, and employment could even be softening. So it's a consistent picture of uncertainty is creating the economy sort of stalling. And if Friday's jobs report, which is for February, is under 100,000 jobs, I think the Fed will see that there has been a sudden change in the momentum of the labor markets, and I think that they would have to react to that. Because again, if the economy gets to stall speed and a recession starts, the Fed has to take emergency measures, which means drastic cuts rather than a cutting cycle. I think there's a 64% probability of a June cut, and it's 75% for July, and only 28% for May. If we get a soft February employment report and jobless claims continue to rise, then the probability of a May cut likely goes to 100%.
For a while, optimism reigned, with markets soaring amid a sense of stability. But now, cracks are starting to show. Rising tariffs, massive federal cuts, and growing uncertainty are casting shadows over what once seemed like smooth sailing. The U.S. is dangerously close to spiraling into a full-blown recession. Tom Lee warns that if this happens, it could force a dramatic reversal in policy, with the Federal Reserve possibly turning to monetary easing to salvage the situation. The most unsettling part? Any shift toward recession could bring markets to a standstill. But here's where it gets mind-blowing. Lee suggests a radical, game-changing move. What if the US started building massive Bitcoin reserves? Treated as digital gold, Bitcoin could become a hedge against inflation and stabilize the national deficit. This audacious strategy could completely alter the course of global finance, making Bitcoin a cornerstone of national economic policy. Let's watch more clips from the interview.
I think if we start from a high level, as long as the economy's in expansion, and as long as there's firepower on the sidelines, meaning investors aren't over-invested in stocks, stocks should continue to rise. And that's been really the right way to look at markets since 2009. If the business cycle matures or experiences a shock in a way that triggers a recession, and it's one that begins to look really severe, then markets can't go up anymore. In other words, we could have a growth scare this year. And I think that's what's really, this is all shaping up to be. And because we could have 1 or 2 weak job reports, Fed starts to ease faster, and it prevents the economy from stalling. But if we have a full-blown recession, that's going to be hard to be recommending stocks. That's not the case, and that's not really what we're expecting. I think the second thing that would change our view is if stocks become overvalued. And there's many ways to measure it, but to me, as long as the PE of the stock market is below the PE of the bond market, I don't think stocks are expensive. The 10-year yield is 4.3%. That's roughly 23, 24 times earnings. The median PE in the S&P is 17 times. So the stock market is still cheaper than buying a 10-year treasury. So that was the case in the late 90s. So if you look at the PE, the median PE, it got close to 25 times. And the 10-year was at an implied PE of 20. So the market was expensive. That's really a pretty simple rule of thumb. And if yields move up a lot, that's another way stocks can look expensive, but yields have actually been declining. If digital assets become a form of an alternative payment system, and Bitcoin is viewed as digital gold by buyers of Bitcoin and people who hold and support the network, then it makes perfect sense for governments to actually treat that as a commodity that they do want to have some control over. If the U.S. owns 1 million Bitcoin, which could be, what the strategic, we really don't know the composition and how much Bitcoin they'll own, but if they own 1 million Bitcoin, they would be the largest holder of Bitcoin in the world after Satoshi. That would allow them to exert significant influence on the network. So I think it makes a lot of sense if you look at financial instruments, and if Bitcoin becomes increasingly viewed as digital gold, that the U.S. should have a strategic reserve of Bitcoin.
As far as you're aware, are any other countries have a digital reserve or are seriously planning one?
Well, none of the major G7s have done something like this. El Salvador comes to mind, and it's been a success story for them because El Salvador actually has one of the lowest funding costs for any country. I do think there is a strategic value in the U.S. owning a commodity that actually could rise in value, because it does change the way markets eventually see the U.S. deficit. Because if Bitcoin is something that is rising and the U.S. owns 1 million of Bitcoin and they're going to hold it for 20 years, that in some ways could actually offset a lot of the deficit. When an index, a global index or a regional index like the DAX or China has strength in the first few months of the year, that's a good sign. So I think investors do have to view that as a credible rise. And if Europe is outperforming year to date, barring any geopolitical shift, it probably does signal that Europe could outperform the U.S. this year. Is it making sense that that's happening? I mean, in some ways, I'd say yes, because Europe is more of an industrial and financial economy. So the banks and industrials are larger weights in those indices, a lot less healthcare and a lot less technology. If the global economy is bottoming, so not considering tariffs, but just looking at what's happening with the ISM and the global PMIs, it makes sense that Europe should outperform. The dollar, if it's weakening, probably is favorable for non-U.S. equities. And as far as tariffs go, in some ways, I'd almost say that what's happening in in Europe and also in Asia might just signal that the market doesn't believe tariffs are permanent changes in the sort of global financial architecture, but at the moment are negotiating tactics. And that, of course, the market could ever rethink of that. 3.5% additional outlays for defense is very bullish for, of course, defense contractors and industrials. And it may also force Europe to really think about how they finance all of that. So if, typically Europe runs a balanced budget. So unless they're going to cut spending elsewhere, this could end up being stimulative. It's not lost on anybody that Asia has really been an underperformer for the last 5 years and 10 years. But valuations have gotten so low that we should be more vigilant to the idea that a bull market starts when there's more bad news and stocks don't go down anymore. And maybe that's what we're seeing the first hints of this year, is that there's been a lot of skepticism about what China could do, and even whether or not some of the things that structurally have affected their economy are even fixable, and whether or not businesses can produce earnings in a way that can impress markets enough to get their multiples to rise. But because that skepticism exists, I'd say Chinese stocks have outperformed expectations. So I think people should just be aware that China might be finally a case where all the bad news is baked in.
In a recent high-stakes move in the cryptocurrency market, a Bitcoin whale bet a staggering $368 million on the decline of Bitcoin ahead of the Federal Open Market Committee (FOMC) meeting. This investor employed a 40x leveraged short position on over 4,442 Bitcoins, gambling on a short-term price drop. This leveraged bet increases potential profits and risks, reflecting a broader sentiment of uncertainty and opportunism in the crypto markets as macroeconomic factors come into play. The timing of this bet is crucial, aligning with a week filled with significant economic reports that could sway Bitcoin's value dramatically. With Bitcoin needing a weekly close above $81,000 to avoid volatility ahead of the FOMC meeting, the stakes couldn't be higher. Analysts like Ryan Lee point to critical price thresholds that could trigger more selling or demonstrate resilience, illustrating the tightrope investors are walking. Tom Lee's insights into the broader financial landscape provide a complementary perspective to this scenario. He discusses the potential strategic value of significant Bitcoin holdings for the U.S., suggesting that controlling a major portion of this digital gold could offset national deficits and stabilize economic fluctuations. His viewpoint underscores the influence of emerging digital assets like Bitcoin in reshaping financial strategies and hedging against economic uncertainties. As the world watches these developments, the interplay between traditional economic policies and the burgeoning digital asset economy unfolds. Investors and policymakers are navigating this new terrain, where digital assets are not only investment vehicles but also potential linchpins in national and global economic strategies. As we wrap up, do you think increased government ownership of Bitcoin will help or hurt its decentralized nature? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.